Hello and welcome to NJ Biz Conversations. I'm your host, Jeff Kanige. My guest today is Eric Lewandowski. He is a partner at Saks LLP and the firm's transaction strategy and transformation leader. Eric, welcome.
Thank you for having me, Jeff. It's great to be here.
Oh, well, thanks for taking the time to do it. I appreciate it. Now, you do a lot of work, as your title implies, in mergers and acquisitions. It being just about halfway point of the year, I thought it'd be a good time to catch up and see what the state of the market is. So, what are you seeing right now? Where's the activity, or any sectors, or anything stand out as being particularly active right now to what you're seeing?
Absolutely. We're seeing a ton of activity around private equity roll-ups.
Okay.
And that breaks down into two different areas. So you've got a lot of private equity funds doubling down on traditional roll-up industries. So think of industries like HVAC or veterinary care or others that have been explored over the course of time that they're deemed to be safe and interesting investments where there's a clear strategic playbook to acquire and grow a platform. But you're also seeing another bucket of roll-up activity in industries that are less traditional.
Okay.
We've seen a lot of activity in the death care space. So roll-ups of everything from funeral homes to cemeteries. We've also seen roll-ups in areas that are subsegments of some of those more traditional areas. So historically, we've seen a lot of activity around medical spa roll-ups. And within med spas, we've seen recent upticks in activity around a niche, which is tattoo removal facilities. So it can get pretty specific to the niche, even within a traditional roll-up area as well.
Okay. Okay. And what size deal are we talking about? These sound like relatively smaller deals, less than $10 million. Is that, and then would that be a fair assessment?
That's fair, but it's across the board. So we're seeing some deals that are small, to your point, kind of less than 10 million. And that's usually where it starts, is
Right.
rolling up sort of smaller, fragmented,
Right.
sometimes mom and pop type locations. But we're also seeing much larger deals. So one of the more interesting stories of late in the roll-up space, especially with private equity investment, is near and dear to my heart, is in the accounting industry. So we're seeing a lot
Okay.
of accounting firms, and something like that ranges from smaller CPA firms all the way up to much larger firms that we're seeing like Grant Thornton and others.
Okay. And is this what sort of region are we talking about? Is this the Northeast, the country as a whole? I mean, where is the activity occurring at this point? And
Across,
pick any one of those sectors. You mentioned veterinarian, death care, accounting. What's the geographical distribution?
sure. So I'll pick accounting. It's happening across the U.S. and even internationally. A lot of firms that are being looked at have an international presence, which is attractive because it helps balance out any fluctuations going on in the U.S., like high interest rates or other fluctuations. But it's national, but layered on top of that is also an international flair as well. So
Okay.
quite broad. I would say that there are some funds that have a specific strategy or mandate that does focus on specific regions. So we do see some of those plays, um, but generally it's across the U.S. In terms of coverage.
Okay. And what is the availability of financing? I mean, we interest rates obviously had moved higher over the past couple of years. What does the financing market look like? Are these is it are firms having difficulty getting financing in place?
There are some challenges for sure. So financing is still expensive. There's still a big question mark as to when interest rates might come down. And I think there are some firms that have decided to strategically say, look, we're going to bite the bullet. We're going to invest ahead of that interest rate cut so that, you know, people knowing that we're having to get lending that has high interest rates might work that into a valuation in a deal. And there's
Okay.
other funds that are looking at that and saying, let's kind of look around. If we find great deals, we'll execute something, but let's hit the pause button a little bit until we see that progress happening with interest rate cuts. So it's a bit mixed right
Okay.
now. Um, so it's interesting to kind of see.
Okay. You mentioned valuations. I was going to ask you about that later. I'm curious how that goes now. I mean, for a time there, I was told it was kind of difficult to come to an agreement on valuations in many cases. Has that sort of passed, and are folks, have the market sort of settled down enough so that folks can get a real good handle on what some of these things are worth?
Yeah, coming out of COVID, valuation multiples had an uptick, especially in the roll-up space. Over time, that's come down a bit and is stabilizing a bit with interest rates being what they are. It's a bit of a TBD in terms of what happens once interest rates do start to get cut. If multiples start to tick back up to where they were kind of in that post-COVID peak. The other layer on top of valuation to think about is, especially for that non-traditional bucket of roll-up industries, is where do those multiples go? There are certainly some precedent transactions, but certainly not as many as you'll see in the more traditional bucket of roll-up industries. So
Okay.
there's a bit more of a, let's kind of see where multiples will go and how high they'll go as the company scales. That's to be determined.
Okay. And what I remember, your firm was involved in a conference I'm thinking maybe the end of last year on the veterinarian space.
Yeah.
And I remember talking to folks then about what was driving that. A lot of it was older folks, older business people, reaching retirement age, and not having an heir to sort of pass it on to, and looking to sort of get out and retire. Is that still a big factor in what's driving those roll-ups, or are other things in play now? For
It,
example, I'm thinking specifically of whether there's a dearth of targets that
yeah,
private equity
sure.
firms are looking at. So, what is driving? I won't put words in your mouth. What is driving those kinds of deals at this point?
Yeah, no, you're exactly right. People retiring definitely is a key driver as to how businesses might change hands. But there are also other drivers as well. We're seeing many instances where a business owner wants to focus, especially in the example you gave of the veterinary space, a business owner may want to focus solely on the clinical side and not
Mhm.
get as involved in the day-to-day business side of the business. So they want a financial partner who can help with back office work like paying payroll or managing the books, whereas they could just kind of focus purely on the clinical work that they went to school for, and that's their interest. So that's another driver as well. To your question about fragmentation, markets are still highly fragmented, even in the more popular industries. So there are a variety of deals, a variety of ways that deal makers go about finding those deals to find those fragmented businesses and roll them up as part of a broader platform play. But I wouldn't say in any of those industries we've seen true consolidation where the market has been saturated and there aren't as many targets to go after. Certainly, there's some more competitive markets than others, but we haven't seen that saturation yet.
Okay, all right. Now, those are established businesses, for the most part, right? I mean, when we're talking about folk getting ready to retire, obviously those businesses have been around for a while. Can you tell us anything about what the market's like for startups? I mean, what are they looking at? Is there interest there? The IPO market seemed to sort of recover a little bit in the early part of the year, although that may have slowed down. Is that changing the calculations? What's if you're a startup owner right now, what are you looking at in terms of what interest there might be in investment or an exit?
Yeah, absolutely. So thinking about the roll-up space, actually the multiples drove up a need to sort of build versus buy, and that has continued into this year as well. So veterinary is one in particular where many veterinary platforms hit the pause button on doing acquisitions because post-COVID multiples have gotten to such a high level that it just didn't make economic sense to acquire at the same pace as before. So they transitioned into, well, let's build, let's start up a company or a site to add to our portfolio as opposed to going and buying. And that's continued into this market. I think generally for startups, we're seeing a lot of capital being raised, and there's certainly capital out there to fund new ideas even outside of the roll-up space. There are interesting niches that are more popular than others we see in this market. So consumables has taken the forefront for either people, for pets, and other products is what we're seeing in the market today.
Okay. And we've been talking mostly, I think, about private equity firms, but I'm curious as to what the market is like for strategic buyers. Are they still active? Are there still strategic buyers out there, and are they doing deals?
Absolutely.
Right.
Still active in the marketplace. And frankly, probably part of a lot of the same deals that you see private equity funds get involved with as well. And where that transaction goes just depends on who's the better fit, who's the highest bidder. But certainly very active. Obviously, they're facing similar situations with interest rates being high as private equity funds. So they may have a different kind of investor base, a public investor base to report to as they take out some of those loans and make some of
Mhm.
those bets. So how often they're sort of executing some of those in comparison to private equity can be tricky just based on what those investors, what their appetite is
Sure.
for going after new deals. But yeah, we're certainly seeing a lot of activity with corporates as well.
Okay. All right. Interesting. Are worth keeping an eye on. I'm curious also whether the regulatory environment is changing calculations. Right here in New Jersey, we saw a couple of fairly large hospital deals get quashed by the federal regulators. Has the Biden administration's approach changed folks' thinking about where to go and what to do?
I think even beyond the administration, I think generally there's more of a consciousness, especially in the healthcare realm, where there's financial investors looking to invest, and still it is hugely popular in spaces like healthcare, where there's a high regulatory component to the industry. So I think it's a mix of administrative items. It's a mix of just general legal sentiments in the industry, sort of what's acceptable, what's not acceptable from what's been in the past in terms of the involvement. I would say there's certainly a strengthening of corporate practice of medicine laws.
Right.
So drawing that line a bit more clearly between financial buyers and those businesses that have a clinical component, whether it's a health system, a multi-site healthcare facility, veterinary even, that line has gotten sharper over time. And I would expect that to continue to get sharper. Another interesting layer to that too has been historically there have been very strong laws or strong enough laws for non-compete agreements. So a clinician might be part of a an acquisition deal in healthcare, veterinary or otherwise, and be bound by a non-compete. There's been a loosening of some of those agreements with recent changes as well, where a financial investor making an investment might say, geez, do I know if this clinician's going to stay? They're
Okay.
keep the
Mhm.
driver here for the thesis of the investment. So that's another question mark that's layered on top of this too. Um, some interesting angles.
Okay, well that leads to the next question then, and and what are the challenges? I mean, what are there? I'm going to get to eventually. I'm going to ask you for sort of an outlook of what's going to happen for the rest of the year. But for now, I mean, is there? There's a lot of uncertainty. We got elections coming up. There's still the uncertainty surrounding what the Fed's going to do, and as we just mentioned, the regulatory calculations. Are those the sort of most important challenges that deal makers face right now?
I think those are. I think one other layer to that to think about too is as you think about interest rates, there's certainly pressure to kind of see where that goes um, before diving in and growing a platform,
Sure.
because you'll have the expense of those payments. But weighing against that is also the pressure of a private equity fund saying, I've got capital to deploy. And if I don't deploy that, which is my job, that's going to make the next fundraise a bit harder. So there is actually a great deal of dry powder on the sidelines, kind of waiting for the right moment. And I do think there will be a boom in acquisitions, especially from financial buyers, once there is a bit more clarity on what happens with interest rates, and hopefully a view that they're going down and sequentially going down more than just once. Um, so that's something to think about too, is that dry powder is there and just
Okay.
waiting for the right moment. Now, some firms have gotten ahead of that. You've seen in the news, firms like Blackstone and others have said, we're going to kind of put interest rates to the side for a moment and try to go after good deals. Nonetheless, we know interest rates will come down in time. We'll just kind of do that strategically and find the right deals as they come along. But others have kind of hit the pause button to just make sure they're doing the right things economically for their investors.
Okay, well, that does lead then to the last question I was going to ask you, and that is about what the outlook is. Obviously, there's still a lot. All those factors that we just mentioned are going to continue to be factors in the second half of the year. What do you expect in terms of deal volume at this point for the rest of the year? Is it going to are folks going to pull back until they see, for example, the result of the presidential election, or what happens with the wars in Europe and the Middle East? I mean,
Mhm.
what is your how do you assess what the way people are thinking right now about the rest of the year and into 2025?
I think it'll be mixed. I think there's a lot of reasons why people would pull back and wait. For all the reasons you mentioned, interest rates, elections, um, variety of other factors. But I also think that as deal makers have that pressure to find the right deals, deploy capital, they're still going to be strategic in making acquisitions. So acquisitions will still continue. I don't think it'll be a dead market by any means. I think there's an uptick to come. When that is, it's hard to tell, and I think it'll be closely linked to a bit more movement on the interest rate side. But I think it'll be mixed for the second half of this year and into early next year as well.
Okay, well, we'll leave it there, and I hope you come back and give us an update on where the market's going and where it ended up. That would be great.
Absolutely.
Okay, Eric Lewandowski, partner at Sachs LLP. Thanks for joining me. I hope we do have a chance to talk again.
Pleasure speaking with you, Jeff. Thank you.
And thank you all for watching. Until next time, stay safe, everyone.